Sandip Kumar Agarwal, IT analyst at Antique Stock Broking, joins us right now on the show. Sandip, thanks so much for joining in. Your peers are divided right down the middle. I read a number of reports, some of which said that Infy has not met expectations at all, and somehow the performance in the next few quarters would be extremely crucial to meet expectations. In light of that, one, what would be your view on Infosys as a stock at the current levels, and how does it augur for the other IT majors in terms of their earnings to be reported?
Okay, if you see Infosys results, the most important thing to note in the result were two. One was the on-site growth in the business, which was around 6.7%, while off-site was just 2.8%. Now in this business, what generally happens is the project, when it starts coming in, always it starts with on-site, because most of the time you have to define the requirement and you have to start executing the project on-site. That is how it comes. So first of all, on-site growth of 6.7% is a very, very positive sign. Now, if you see the operating metrics, basically which are the main triggers to the margin expansion and everything. First of all, if you see utilization levels have shown improvement, we were expecting it to happen in this quarter. So we were not that bearish on utilization level in last quarter when the management came with a 400 basis point margin decline guidance, and they have themselves cut it down now, say 250 basis point. We believe that utilization will improve further. See, one more important thing to notice is till now they are only adding laterals. So now from this quarter, that is joining date for fresher is always from July. So you will see the impact of wage rationalization going forward. So that is one trigger which will come into, and that will reduce the employee cost first of all. Secondly, utilization levels are definitely going to improve. And thirdly, the on-site execution which they have done, which has resulted in approximately 45 to 50 crore of incremental subcontracting costs, that will start getting off. So all these three things will enable margins to improve. We strongly believe that the company will exit the full year at max at 80 to 90 basis point margin decline versus FY11. Also in the next quarter itself, we believe that management will further cut down the margin decline guidance from 250 to at least 180 basis point. That is what my view is. Because see, this industry is like that. You have to add capacity, and the capacity actually gets built after a lag. So that is the benefit which TCS was getting for last 3 quarters, and they will continue to get in this quarter, and then probably they will have to again add lot of capacity, which will have again 1 quarter lag. So what I am trying to say is that this quarter again you will see a industry leading growth from TCS of let's say 6.5 to 7%. That is what we are assuming, and EPS of 12 rupees 80 paisa. So it will be good set of number. Only factor will be the tax, which is expected to go up in this quarter from 18%, which they exited last year, to 22% effective tax. So other than that, results look good. But main important thing in TCS will be again utilization improvement in this quarter vis-a-vis last quarter. Last quarter they lost 140 some utilization. It was at 82.4. This quarter we are expecting again it to be at least 83.4. So that will enable the margins to be stable almost on EBITDA or operating level. But net margins obviously will decline because of higher tax impact. So we don't see much worries on that front. In fact, if you see global numbers and the spending, there is no fear on the spending front. Yeah.
No, Sandeep, I agree. I mean, while I agree with this broad analysis, my question to you, what I really want to get out for our viewers is that we've seen a bit of an underperformance in terms of how the stock market performance is of Infy vis-a-vis TCS. So Infy is corrected quite a bit. TCS has an HCL Tech has held out as well. And probably you discount this quarter's earnings. The point being, with Infy saying that they'll do 130, HCL Tech commentary last quarter, and TCS showing what it is doing, they don't give guidance per se. What is it that you would bet on at the current levels? Would you go in for an Infosys after the correction that it has shown, or would you still stick with an TCS or an HCL Tech at the current price levels?
No, we will go with Infosys. In fact, our picking order currently is Infosys followed by TCS. HCL, we are not very bullish from this point, and we probably have a cautious view. So our picking order remains Infy TCS. So post this correction, in fact, Infy is more attractive because the potential upside is more than what we can expect in TCS.
And you're not bothered by the fact that a lot of people have said that September quarter, possibly even the December quarter, Infy will have to outperform by a wide margin just to be able to meet expectations?
Yeah, that's correct. But again, Q2 is always a very strong quarter for Infosys. And if you see the 3 large transformation deals which they have won in the previous quarter, and management themselves have said on yesterday on the call that it will result in better volume growth in next few quarters. So if you see the last year also in second quarter they posted a sequential growth of around 12% in INR. So second quarter will definitely be a much stronger quarter. And probably that will take off much of the worries, and we expect EPS to be revised upwards again by the management in next quarter.
Sandip, what are you recommending from the mid-cap IT space then?
Mid-cap, we are recommending CMC at current levels. In fact, we are recommending it for a long time now. Again, the story there is more from the domestic side, although they generate 48-49% of the revenues from US, but balance 48-49% is primarily from India, and India is a very strong growth market if you see the domestic IT services going forward, and particularly the opportunities which will be thrown out after the rollout of UID. You will get business into digitization, scanning, you will get business, a lot of business in education and training, and you will get a major business into software maintenance, upgradation on the UID platforms. So I think there is a huge business opportunity there. In fact, NASSCOM, Gartner all are expecting this CAGR to be 15%. They expect India to be the fastest growing domestic IT services market, and CMC being having a strong presence in this market since so many years and executed the most complicated projects for the government. They obviously have an edge on this, and we believe that the education and training, system integration, embedded solution, these all segments will do very well. Only laggard in this year will be their tax rate, obviously, which they will exit this year at 25%. That will not allow the EPS growth to be substantial. But next year they will again return back to the old tax rate once they do the transition to SEZ, and you will see a huge growth in the EPS.